good afternoon again, everybody. My name is Dana Hagan. I'm the President, CEO of Retirement LLC, and Chris Hyatt, our Business Development Manager out of the Oklahoma City office, is with us as well. We've got a pretty small group this morning, so should give us lots of opportunity to get all of your questions answered and to be able to get through this in a fairly short period of time. So again, thank you for joining us, and we'll get started. Just to begin with, Retirement LLC is an independent third-party administrative firm. We're based out of Oklahoma City with offices in Sioux Falls, South Dakota. I'm out of the Sioux Falls, South Dakota office. We administer approximately 1,100 companies' retirement plans throughout the country. We have defined benefit and defined contribution plans. We have actuaries on staff, so that makes us pretty unique in the TPA industry. One thing that is a new development, which is really important to you as an advisor, is to know that Retirement LLC is a CFEX certified not only record keeper but administrator. In the world of TPAs, there are really few, if any, requirements. And so out of the 1,800 TPAs in the country, less than 70 of them have gone through the effort of becoming certified through CFEX. CFEX is a combined organization of FI 360 and the American Society of Pension Professionals and Actuaries. And so we're very proud to be among those 70 TPAs. And so just wanted to point that out as our quick advertisement before we get started on cash balance plans. So our topic today is just an introduction to cash balance plans. We're not going to go into great depth. It's a very detailed topic, but the information that we're going to share today is going to give you a very good working understanding of what you need to know and maybe the questions to ask when you're looking at cash balance opportunities. So one of the things that this presentation is designed to do is to set you apart from the crowd. There's lots of people that can talk about 401ks and maybe talk about cash balance plans, but few of them. Even a lot of the CPAs I found in my 20 years of being in this industry are fairly lacking in understanding of what a cash balance plan is. And there's lots of opportunities out there with existing clients that could have been taking advantage of this type of plan for a long time. So this is going to help kind of set you apart from the crowd. So cash balance plans are the fastest growing plan that you've never heard of. Now, that's changed a little bit in recent years, but when I really started to get into the cash balance plan market, the questions I often received were, is this even legal? And it's important that you know that these plans have been around for a long time, since 1985, and the IRS has just approved the prototype document for cash balance plans in the last few years. So these are a well-established plan, very fast-growing plan as a percentage of qualified plans, and so they're a pretty unique tool. So we say that a cash balance plan is a hybrid plan. And what we mean by that is that it allows for much larger contributions. They're all employer contributions, by the way. The common question I get asked is, can employees put any money into a cash balance plan? And the answer to that is no, it's all employer contributions. So we've got much higher contributions, but we have all of the flexibility and portability as you would normally see in a 401k plan. And by portability and flexibility, I mean that we have the flexibility to set the level of contributions. We have a little bit of variability in the eligibility, who's going to be able to become eligible to participate in the plan. And then the money is portable once the participant were to terminate from their employer or the plan itself is terminated. Those monies are eligible to be rolled over directly into an IRA, so we can preserve the tax-deferred status of those within an IRA, even after the life cycle of the plan itself has terminated. So they're much more understandable. When you think of a defined benefit plan, you think of some hypothetical future accrued benefit at some age of retirement. So it's very nebulous. It's hard to understand. But a cash balance plan is named exactly what it sounds like. When a participant gets their balance, their statement, there actually is a cash balance that shows them how much money is in their account. And it's a hypothetical account balance, but it's based upon all of the actuarial accrued benefits in the background. So that is something that makes it look and smell very much like a retirement plan, like a 401k plan. So there's a bit of a stair-step approach in this, in that oftentimes a new company may start off with a simple or a SEP, but as they graduate and become more of an established company, oftentimes they'll move into a 401k plan, a safe harbor 401k plan. Then once they get to that point and they want to put additional contributions in, they'll add in a profit sharing contribution. And once they are maxing out the 401k profit sharing and want to be able to do more, the logical next step in that would be adding on a cash balance plan. And a cash balance plan oftentimes, not always, but oftentimes is partnered with a 401k plan. So they work in concert together. And it's a little complicated, but much of the non-discrimination tests of a cash balance plan we can satisfy within the 401k. And the reason we do that is to reduce the contribution requirement to the rank and file and try to maximize the contributions to the individuals. So there's two types of money that go into a cash balance plan. You're going to have the employer contribution. Those contributions generally go in annually. Sometimes a company will want to fund those quarterly, but oftentimes it's annually, much like you would with a profit sharing plan. And then there is an interest crediting rate. It's the rate of return that the investments would receive. Now, a quick note about the investments themselves. The interest crediting rate is a defined rate of return in the adoption agreement of the plan. So it's generally going to be set somewhere between 4 and 5% because we need a rate of return that's going to be predictable, somewhat stable. Now it's going to fluctuate year over year, go up or down a little bit based upon what we're tracking, but generally we want them to track towards that interest crediting rate. And so those two contributions, the employer contribution and any rates of return, is what the account balance is on the plan. And we can talk a little bit more about that interest crediting rate in the Q&A section. There's different rates that you can set. Most often it'll be a fixed rate. You can set it based upon the 30-year treasury bond and other market rates, but by and large, we usually always set it as a fixed rate. That's usually the most manageable way to set the interest crediting rate, the guaranteed rate of return in these plans. PBGC is the Pension Benefit Guaranty Corporation. This is the insurance coverage of a pension plan. A lot of the plans that we work with are actually exempt from PBGC. So some of the individuals that would be exempt would be professional service firms with 25 or fewer participants. Those would be your law firms, any medical practice, different firms like that. Trying to think of some other ones, architects, those sort of types of firms. We also do quite a few owner-only plans, and those too would be exempt. If they're not exempt from PBGC, then there is an annual premium that they have to file with the PBGC on an annual basis. So that's one of the expenses that's included in a cash balance plan. So the key benefit is high tax deferrals, not high rates of return. Like I mentioned in the previous screen, we're going to set that interest crediting rate at an attainable 4 to 5%. And over the course of a 10-year period, you don't have to track on that every year, but over the course of a 10-year period, we want to be able to track on that, and there's ways to get it back into balance if it were to underperform, for example. Generally, it's going to come in the form of additional contributions by the employer, which may or may not be a bad thing, depending on, if they're the ones getting the lion's share. But the benefit is the tax deferral amount. If they want to be more aggressive with their investments, they're going to want to do that on the 401k side, not in the cash balance side. So when you think of a pension plan, cash balance plan is a pension plan. You think of large employers. I always think of Coca-Cola or United Airlines, these large employers that have had pension plans, sometimes associated with unions, and they've been in the news a lot. A lot of them are, especially at the state level. Cash balance plan, although it's a pension plan, it is not. It's really meant for small employers. Generally, 50% of the plans being created have 10 or fewer employees in it. So this is really a small employer play, if you will. Really, it can fit good for larger employers as well, but generally, the smaller sometimes the better, especially if they're highly profitable. I mentioned a little bit earlier, but most cash balance plans work best when working in partnership with a 401k profit sharing plan. By providing a profit sharing contribution to all of the eligible participants, it reduces the amount needed to be given to the rest of the staff on the cash balance side. It's not uncommon for us to be able to get the contribution amounts on the cash balance side for the rank and file down in that 2% range, while we're still providing the key individuals, oftentimes the owners, $100,000 to $250,000 in contributions. So we can create quite a disparity using the profit sharing side with the contribution. So the short side of that is that all the participants are going to receive something. How much is an unknown until we can actually run an illustration. But if we can provide them the benefits on the profit sharing side, it really helps us reduce that amount on the cash balance side. So here's a very interesting rule with a cash balance plan. It's called the 40-50 rule. And what it is that the benefit of the cash balance plan only needs to be given to 40% of the staff. In other words, you can exclude 60% of the staff, and I'll show you an example of what that looks like. Another interesting rule is that it has to be 40% of the staff to a maximum of 50 employees. So those two rules can really come into play quite nicely, and I'll show you what I mean by that. So if you have a company with 10 employees, the cash balance plan needs to cover 40% of them, or only 4. In other words, we're excluding 6 of those employees from receiving any benefit at all. If you've got a company with 5 employees, for example, and 2 of them are a husband and wife, then that 40% threshold is going to be covered just by the husband and wife, and the remaining 3 staff can be excluded entirely. Now, the perfect combination would be a sole proprietor, but where it's all going to those key individuals. But when we do have employees, it's nice to be able to sometimes carve out those that aren't owners. A lot of times, though, an employer, a business owner, will at the end of the day say, you know what, rather than excluding a certain percentage of my employees, I'm just going to give them all a contribution on that cash balance side. It might be a small contribution, but it creates less maybe questions if other employees were to receive the benefit and other ones didn't. Now that 40-50 rule, remember I said that maximum of 50 employees need to receive the benefit. So if you have a company with 1,000 employees, the cash balance plan needs to only benefit a maximum of 50. So it's 40% or 50, whichever is less. So when you think of a hospital, for example, you may have a hospital with 1,000 employees, and maybe 100 of them are doctors or 50 of them are doctors. You can create a cash balance plan that's creating a benefit really targeted at the medical staff and excluding the rest of the employees. So that can be a pretty powerful tool as well. So you can see where, while this works very well for small employers, it also can work pretty well for larger employers as well, especially if they've got a targeted group of individuals that they're trying to benefit. So let's talk a little bit about the commitment level. So as you probably know, in a 401k profit sharing plan, the employer has the ability to increase or decrease the contributions, especially in the profit sharing side, with complete discretion. So they decide on an annual basis if they want to put any money at all into the profit sharing, and they decide how much they want to put into the profit sharing side. When you're dealing with a pension plan like a cash balance plan, there is an expectation of permanency, the way the IRS defines it. And so these plans are going to have a required contribution, and we're going to want to see that they're in place for usually 3 to 5 years. The longer, the better. Now, there are exceptions, but the commitment is higher in a 401k, and I'll just mention the exceptions really quick. So we do have the ability on occasion, every few years or so, to be able to amend the document to change the formula. The formula of the contributions are going to be defined in the document. Maybe it's a percentage of their earnings, for example. So if they made $200,000, we're going to put away 25% or $50,000 into the cash balance plan for those individuals. If they get into a lean year, we have the ability on occasion, we don't want to do it every year. That creates a cash or deferral arrangement, which is not looked upon well by the IRS. But we can go in and change the formula as needed on a somewhat periodic basis. Now, if the cash flow in the company itself has declined significantly, so something has changed in their business model, or maybe with an illness with a key individual, well, the IRS says that if the cash flow in the business has altered significantly, that gives you every right to go back in and amend the document to significantly change the formula to reduce the contributions. You would even have the ability, if need be, to freeze the plan so that any accrued benefit would have to be paid, but any future contributions would not have to be paid while the plan is frozen. If they came out of that low point in their business, and they could unfreeze the plan and resume it down the road, or in the worst case scenario, they could even terminate the plan if need be. So there are some exit ramps in a cash balance plan to provide some safety nets. So while there is a larger time commitment, we do have some pretty nice safety nets to be able to not get them into a cash flow crunch if that were to happen. So let's talk a little bit about identifying candidates that would be good prospects for a cash balance plan. Generally, you're going to want owners with incomes greater than $250,000. Now, this is just a rule of thumb. I have certainly set up cash balance plans where the owners have a lot of hay in the barn. They don't really need any current income because they've saved so well, and so maybe they make $150,000 or $100,000, and they want to be able to save as much of it as possible, if not all of it, into a tax-deferred vehicle. Well, we can do that with a cash balance plan, but generally it's going to be those individuals that are high income earners at $250,000 or higher. We want to see consistent profit patterns. So if they've got a history of being very profitable, we have done cash balance plans for farmers, for example. They're a hard nut to crack because they just don't believe in investing. They believe in buying equipment, or buying dirt, and it's hard for them to invest in anything, especially where it might be locked up. But it can be done, and it can be very effective. But of course, farmers, it's feast or famine for those folks. So in those lean years, they want to have those safety nets where they're not required to have those contributions. So the typical type of plan that we're looking at is going to be a firm that's going to be a medical firm, a CPA firm, law firms, very common. Any small family-owned, highly profitable business, especially if they've got an existing retirement plan, a 401k now, and they're hitting the maximum contribution amounts, then this would be a really good fit to look at. There is a ratio of owners to employees. Generally, we want to see 1 to 2 owners per 10 employees or less. So if you had, for example, 1 owner and 300 employees, it's going to be very challenging because the contribution requirements to those 300 employees, or 40% of them, is going to far exceed the tax benefits for the 1 owner. But if we've got 1, 2, 3 owners for 10 employees or less, I just was dealing with one with 3 owners and 6 employees, so that's fantastic. So anytime we've got that 1 to 10 ratio or less, that's a good candidate. And then you have to have business owners that's willing to give their employees 5 to 7.5% annually on their gross earnings. This is going to be the contribution amount, the rule of thumb contribution amount that's going to be on the 401k profit sharing side. So if they're willing to give their employees, say, a 3% non-elective and a 4.5% profit sharing, then they're a good candidate. So there are some owners, I just dealt with one the other day that absolutely doesn't want to give his employees anything. He feels their paycheck is enough and doesn't want to give them any other benefit, including health benefits. Well, that's tough. But fortunately, those types of business owners there's very few of them. If they usually don't stay in business too long if they are around. So most of them understand it, and the value of the tax benefits that they receive personally over the contribution of their employees. Usually it's a bit of a no-brainer. It's pretty easy math. So again, any business that's maxing out an existing 401k profit sharing plan would be a good candidate. So let's just take a look at some limits, because this is where it gets very interesting. What we've got in the far left-hand column are ages, age 65 and above, going down to age 35. The first column with dollar amounts is 401k profit sharing. This is the 415 limit for 2018. So if you've got somebody that's age 65, the maximum they can put away between their deferral, match, 3% non-elective profit sharing would be $61,000. That drops down to $55,000 for anybody that's younger than age 50. The cash balance plan, you can see, is highly dependent upon age. So the older you are, the more you're able to put in the plan. So those that are age 55 or higher, they're going to be able to start putting away, $200,000 and above. And these amounts are going to be in addition to any amounts in the 401k profit sharing side. So if we just look at the top number for somebody that's age 65 or above, if they put $61,000 in the 401k profit sharing, another $250,000 in the cash balance, they're putting away $311,000. If they're in a 40% tax bracket, that's going to save them $124,400 a year. Now they might end up having to give their employees $20,000, $30,000, depending on how many employees there are. But you subtract that cost versus what they're getting in those tax savings, and it's pretty significant. So what we can do oftentimes is even put these individuals in a different tax bracket in the current year. The goal is to avoid any taxes, but reduce taxes as well. Kick the can down the road, if you will, but also limit taxes permanently. But even for a younger individual that's in their 30s, the contribution in a cash balance plan can be, in say $74,000. So we can get them $100,000 or above. So it can be pretty significant for those folks as well. So that's pretty exciting to be able to see those numbers. And one of the things, I'll just jump to one of the services that Chris and myself can provide, is if we have a census template, and if you can get a census of the company, which would include all of the owners and employees, dates of birth, dates of hire, annual compensation, ownership percentages in their corporate structure, C Corp, S Corp, LLC. We have some pretty sophisticated software that we can run specific illustrations for those companies to show them in black and white exactly what's possible. And frankly, that's our biggest selling tool, is those illustrations. So when an owner can see that in black and white, it really helps them not only see the benefits, but also just understand the mechanics of the plan. So, for example, if we've got a sole proprietor, husband with a spouse or wife with a spouse, and say they're making $150,000 each, or maybe one's making $300,000, and they put the other one on the payroll and paid them $150,000, so they split it. It's pretty easy to get those contributions if we did just a standalone cash balance plan at $100,000 a piece. So have them defer $200,000 on an annual basis just between the two of them. If the dollar amounts are higher in their income, we can certainly go higher than that. But that's just an example of the stuff that can work pretty well. Father and son, this is definitely true in a farming community, but there's a lot of businesses out there that there's multiple generations. So if you've got a father that's looking to retire, he's never put any money into anything because he's always invested into his business, we could set it up where the father is putting away, say, $224,500 on the deferral side, doing another $34,500 in profit sharing, and almost $250,000, $225,000 on the cash balance. We can virtually exclude the son. Certainly we can from the profit sharing. Maybe you have to give him a nominal $1,950 on the cash balance side. He could defer if he wanted to, but I'm just showing a 0% deferral. So in this type of a scenario, what you can do is you can allow a business owner to pack 20, 30 years worth of savings that they haven't done into 5 years or 10 years, certainly, to help set them up for retirement. So when dad finally retires, he doesn't need to sell the business to the son at the top market value. He can, give him a break and sell it for much less. And so this can be used as a succession plan as well, which is pretty interesting. It doesn't have to be a father-son. It could be, say, 3 partners, and the 2 partners want to buy out the one partner. They could use this to leverage a buyout as well. So just understanding the basics of a cash balance plan gives you just another talking point with those high net worth individuals, especially the business owners. Being able to open up a conversation like this, what I found is that you're not going to have that many cash balance opportunities. The ones that you do are going to be fantastic, but it can also provide you an opportunity at their 401k plan if you don't have that. So it can just be another angle to be able to earn their confidence, because I guarantee you most individuals out there don't even have any concept of this. So this gives you an advantage. So it demonstrates the level of expertise and knowledge of a qualified plan tool that many people just simply don't have. This is Chris's contact information with her phone number and her email address. And I'm just going to unmute everybody and see if you have any questions on anything that I've presented so far. So we're unmuted. Do we have any questions? One of the things that I like to do, and this takes quite a bit of time with a cash balance plan, and the sales cycle on a 401k can be weeks, even months sometimes. Cash balance plan is certainly as long, if not a little longer. And so what you want to do is just start talking to those individuals and ask them, if you had an opportunity to save any amount from taxes, what would it be? And if they come in and say, 50,000 or 60,000, well, a 401k is going to be able to get us there generally. If they come in and say, 100,000 or 250,000, well, then oftentimes we might be able to do it with just a standalone cash balance plan and not incorporate the 401k. If they say 200,000, 250, or 300, well, then we're going to be looking at adding a 401k profit sharing and a cash balance. So I guess my point is that depending on what the needs are for the individual, we can use one or the other, sometimes both of these plans, to be able to get them to the contribution amounts that they're desiring. So that's one of the services that we offer, is to kind of help guide them through that and show them the alternatives and see where they want to land at.
Dana, this is Bill Duran. Could you go a little bit more into how the interest crediting rate works?
Yes, happy to. So let's say, for example, we set the interest crediting rate at 5%. So what happens is, actuarially, we have to hit that 5% on an annual basis. You as the advisor, there's a lot of broker dealers that will help come up with a portfolio of a mix of, say, bonds, money market. There's going to be some equity in there that is going to, over time, track towards that amount. I've seen some 10-year projections where it really is pretty amazing, even with, say, 2008 in there as well, where the market dropped. But there are also, I just set up a cash balance plan the other day, and the advisor didn't want to have to pick the investments themselves, just didn't feel comfortable doing that. And there are mutual funds out there that are designed specifically for cash balance plans. Peyton Kravitz is one of the fund managers that have designed those, and they've built in different compensation structures for you on that. But let's talk a little bit about if it underperforms or overperforms. So if we set it at 5% and it overperforms, and say we got, I'll just use 10%, so we got a 10% rate of return, great. That's not a bad thing. But there are funding levels, and we can't have it overfunded. And so what that would mean is that the anticipated contribution the following year, maybe we set it at $100,000, and that's what the employer or the owner was anticipating. If the funds overperformed, that may have to be reduced. So maybe they can only put in $90,000, for example. So their tax-deferred contributions are reduced in that situation. Now, the reverse would happen if it underperformed. They may have to put in additional contributions. So they were expecting 100, now they're going to have to put in 110,000, for example. Now, that doesn't happen very often, especially in a cash balance plan. And there are ways actuarially that we can remedy a underfunded plan. I was actually speaking with our senior actuary the other day about this, and I said, he's been doing this for decades. I said, have you ever had a cash balance plan that got to the point where it was underfunded to the level that intervention had to be taken and they had to make additional contribution? He said, no, actually, I never have. But if that were to happen, you could do it over say a 7-year accrual period. So you would do it over 7 years, where you would put in a little bit more over a 7-year period. But generally, it's going to recover with the investments the next year or the subsequent year, so you don't have to worry about that. Does that answer your question? Does that help?
Yes, thank you.
Good. You bet. Absolutely. Any other questions? Well, hearing none, I would just like to end by thanking you, first of all, for participating with this webinar. And if you've got any opportunities out there, let us partner with you on that. We've got a really good staff of actuaries, and we can help you explain this product to your clients, and allowing us to partner with you will help you be able to add significant assets under management with these types of plans. And just as importantly, you can provide just an amazing benefit to your clients that they maybe haven't realized in the past. And by getting us involved, we also can help communicate with the CPAs, even if they've got an estate attorney involved with them. Whatever expert needs to have this explained in the process, we're happy to do that to help everybody have a comfort level at the end of the day, because that's really, really important. So thank you again. Have a great rest of your day. And again, thanks for joining us.